Interest rates have skyrocketed above 5%. Demand is decreasing, supply is increasing. Are we about to see a housing market crash? Well, you're going to have to stay tuned to find out. Hi, I'm Josh Alexander from The Brokerage and your host of Orange County Housing Market News, your one-stop shop for all things Orange County real estate. So on today's episode, I'm going to be going over my May housing market forecast. So we'll go over what's been happening in the housing market, what to expect over the next couple weeks and coming months, and on top of that, what that actually means for both buyers and sellers if you're looking to enter the market at the end of spring, early summer. So without further ado, let's go ahead and get into it. So like I typically do in these episodes, I'm going to break it down into three parts. So first, we're going to talk about what happened last month in the month of April. Number two, we're going to talk about how that set us up and what to expect over the next couple weeks and coming months as we exit spring and into the summer market for the housing market. And then number three, most importantly, what this all means for both buyers and sellers looking to enter the market over the next few months. So let's go ahead and start with what happened in the month of April. So let's go ahead and look at supply side first, because those are the numbers that caught me more off guard than anything else. So I'm going to put these two charts right up here. So if you're listening to this through podcasts, I apologize, but I'll try to walk you through these. But it's just a visual representation to see how dramatic we've seen a difference in both supply and demand pan out over the last 4 weeks. So on the supply side, we've seen an increase of 36% over the last 4 weeks alone. And 21% of that came in just the last 2 weeks. So supply is really starting to increase at a much faster rate than it has been any time in recent memory. In fact, over the last 2 years, supply has basically been on a downward spiral since the beginning of the pandemic. So to see supply go up is definitely something that I'm excited about because we really haven't seen that in almost 2 years. So now let's go ahead and look at the demand side. So on the demand side, the percentage drop has not been as significant as the supply side. However, you can tell by looking at this graph up here that demand has gone down pretty significantly. And it's also important to know that typically during the month of April in Orange County, we're still seeing demand go up at this point. So to see a drop in the month of April is definitely not something we see very often. And why is it dropping and why is supply increasing? It all has to do with interest rates. At the beginning of the year, we started right around 3.3% interest rates. And right now, that's looking like a bargain because over the last 4 months, we've seen it shoot up from 3.3% all the way up to 5.5%, which is where it ended at today, which is May 4th. So we've had over a 2% increase in the interest rates in a very short time frame. So this type of quick increase hasn't happened since at least 1998. So it's definitely not normal. And that really has been the primary driver of demand going down and supply going up because the payments that you have to make now compared to the beginning of the year are completely different. So let's go ahead and break it down in a quick example because that's the easiest way for me to really visualize the difference it's going to make on your monthly payments from the beginning of the year to right now. So let's say you're trying to purchase a property that's $1 million at the very beginning of the year at 3.3% interest rate with 10% down. To make the example easy, let's go ahead and take out the property tax and insurance and just focus on principal and interest. So if you were to buy $1 million property at that 3.3% interest rate with 10% down at the beginning of the year, your monthly payments would be right around $3,941. However, if you were to buy that same property when the interest rate is at 5.5%, guess how much your monthly payments are going to increase? $1,169. You'll be paying $5,110 per month to buy that same $1 million property right now because of the higher interest rates. It's an insane amount of money. That's over $14,000 more on your mortgage every single year. But let's go ahead and look at this through a different lens. Let's go ahead and assume that you're more focused on the monthly payment. You want to keep that monthly payment right around $3,150, which is what it would have been if you bought that $1 million property at the beginning of the year with the lower interest rate. In order to keep that payment the same, you're now going from $1 million property and now only able to look at properties around $780,000. That's a giant difference. It's a completely different type of home in a completely different type of neighborhood. And that's not even factoring in appreciation. In Orange County, we've had more than a percentage increase in appreciation every single month since the beginning of the year. So realistically, you'd be looking at homes that are probably $750,000 or less right now compared to that $1 million home that you were looking at the beginning of the year. That's a 25% decrease in your affordability in just 4 months alone. So you can see why we're starting to see this giant shift in both supply and demand. Now, after looking at this data, you might be thinking to yourself, and it makes complete sense, that we must be in some type of housing bubble. If affordability has dropped 25%, there's going to be a housing market crash right around the corner. And again, I can completely understand why you would think that, because just looking at that data alone makes it look like this housing market has to crash sometime soon. However, I am here to tell you, no matter how many headlines you're reading, that the housing market's crashing, that demand is going down, that supply is going up, that the housing market is not going to correct anytime soon. The data just does not show that happening. So let's go over a few numbers to really see what's happening behind the scenes so you can get a better understanding of why the housing market is still on solid fundamentals and we're not going to see a giant housing crash anytime in the near future. So let's go ahead and start with the supply side first. So even though supply has shot up by 36% over the last 4 weeks alone, we are still at the lowest supply that we've seen in April in over 20 years in Orange County. Yes, it's starting to go up quicker. However, in order to make up all the deficit of homes that we've had over the last 2 years, it's going to have to shoot up at a much faster rate and for much longer before we get to a point where supply is going to oversaturate the market. And that's just not going to happen anytime soon. Now let's go ahead and look at the demand side of things. So yes, I just showed you that chart that showed that demand was significantly decreasing over the last 4 weeks. However, demand still has a very long way to go down before we get anywhere close to being equal to supply. And on top of that, purchase applications are still very high. So purchase applications are basically any new buyer looking to apply for a mortgage, and that's a good indication of future demand. So right now, they're still higher than most years between 2010 and 2018, showing that demand is still there. And why is that? Well, the biggest reason has to do with the largest demographic patch ever in the United States entering prime home buying years, and that's the Millennials. So between the years 2020 and 2024, the largest patch of those Millennials are reaching peak home buying years, the age of 32. So when they do that, they're going to be able to keep demand at a pretty significant level over the next couple years, which is going to make it pretty hard for demand to drop significantly anytime in the near future. And on top of that, yes, we're starting to see interest rates go up very quickly, hovering around 5.5% right now. But if you look at that number historically, that's still a very low rate. It's not going to be to a point like it was in the 1980s when you were seeing interest rates in the teens, in the 16, 17, 18%. Right now at 5.5%, yes, because we've come accustomed to those 2 and 3% interest rate, it seems like a giant shock right now. However, that 5% interest rate is not abnormal. We've seen it before plenty of times. Yes, it will slow the market down because it does decrease affordability, but by itself, it's not going to crash the market just because interest rates have gone up above that 5% mark. So supply has been going up, demand has been going down, but there's still a very significant gap between supply and demand right now. So how can you best measure how this is impacting the market going forward? One of the easiest ways to do that is to look at the average days on market. That really tells us how fast the housing market is moving, because that measures the days it takes from when the seller places their for sale sign in the yard and puts it on the MLS to when it goes into escrow. At the beginning of April, we were looking right around 23 days on average. Right now, we're close to 30. So yes, it's starting to increase. That shows that the market is slightly slowing down a little bit, but you have to remember, anything under 60 days is considered a hot seller's market. So we still have a long way to go before we get anywhere close to having a market that's going to be more normalized where both the buyer and the seller have about the same amount of leverage when they're trying to purchase and sell a home. So those are some of the main reasons why we're not going to see a housing crash anytime soon. And on top of that, there has been no indication that over the next couple months, we're going to see any giant spike in supply that again is going to get us to a point where we're more even with demand. People are just not placing their homes on the market as often as they used to. They're staying in their homes longer. Right now, a lot of homeowners have a great interest rate that they locked in around that 2 or 3% range. So that's just one more reason that sellers don't want to place their house on the market right now, because they got those interest rates when they're at the historically lowest level they've ever been. So it's really tough for them to go from a 2.5% interest rate up to a 5.5% interest rate, because like we talked about, you can see how much that does to their monthly payments when there's that large of a gap on the interest rate. But what about foreclosures? Aren't we going to still have some type of wave of foreclosures that hit the market because of everything that happened with COVID? Again, I've talked about this so many times, but there is going to be no wave of foreclosures. People have way too much equity in their home right now, more equity than we've ever had in the United States for homeowners. Almost 40% of homeowners have paid off their house in full and don't even have a mortgage anymore. And the large majority of the remaining ones have at least 20% equity in their house. So if they had to sell their house, if they did lose their job, they're not going through the foreclosure process. They're placing it on the market like a normal sale, getting a premium for it, and moving on to the next property. So right now, there is no indication we're gonna have any type of foreclosure wave anytime soon. In fact, we've been hovering anywhere between 2 to 4 foreclosures throughout all of Orange County over the last couple months. It's just not going to happen. So if you're waiting for that, I'm sorry to disappoint you, but you're gonna be waiting for a very long time. So I know I've given you a lot of data to start off this episode, and I can go for another hour giving you different data points on why there's not going to be a giant housing crash anytime soon, but I wanna hear from you. Can you comment below, what do you think is going to happen in the housing market over the next couple months throughout the rest of the year? Do you think that we're gonna see a giant housing crash? Do you think we're in a bubble? Or do you think that we're going to see homes appreciate more? I'd love to hear from you, and I'd love to get that feedback. So let's go ahead and move into the last part, which is going to be, what does all this data actually mean if you're thinking of buying or selling a house in the next couple months? Because that's the important part that you want to know about. So let's go ahead and start with sellers first. So sellers, you know this by now, but demand has peaked for the year. So unless we have some type of major world catastrophe that's going to cause interest rates to plummet again, which is not very likely at this point, you're most likely going to see demand drop every single week throughout the rest of the year. So the longer it takes for you to get the house on the market, the less demand you're gonna have, and on the opposite side, the more inventory will be hitting the market, so you're gonna have more competition. So if you wanna sell your house at a great price and be able to sell it quickly with the best terms possible, and that's the important part, because price is great, but having more buyers to choose from is going to enable you to negotiate better terms, less contingencies, lower time frames, and ultimately give you the best purchase price and the most secure escrow possible. You're going to want to get your home on the market as quick as you can to be able to take advantage of that, especially before the end of May, before we head into the summer months, when you typically start seeing inventory go up even faster and demand start dropping even faster as well. Now, if you're trying to sell your house and then need to buy a new house, this is a great opportunity for you as well, because you're able to take advantage of the market on both sides. So on the sales side, you're able to take advantage of the very high demand that we still have in the market. But when you go to purchase a house, which one of the main reasons that a lot of sellers have been reluctant to place their house on the market is that they know they can sell their house, but they're not sure they're gonna be able to find a new place to live. On the buying side, there's going to be more inventory every single week as we head into summer. So you're going to have more options to choose from, giving you a much better chance to be able to find that great home to be able to move you and your family into once your house sells. So if you're thinking about buying and selling at the same time, I really encourage you to try to get your house on the market in the month of May or early June at the very latest, in order to be able to take advantage of both sides of this market. Now, when actually placing your house on the market, the most important thing for you to remember right now is you have to price it correctly. Now, more than any time in the last 2 years, if you price your home over what it's worth, there's going to be a very good chance that it's going to sit on the market, and you're eventually going to have to do a price reduction. And the numbers are starting to show that. We're starting to see week after week that more and more homes in Orange County are having to do price reductions because sellers got too ambitious with their pricing, put it on the market. After about 2 weeks, there's no eyeballs on the property anymore because it's gone through all the sites like Zillow and Redfin and now is in the bottom of the inbox of all of the buyers out there. So they're forced to do a price reduction. And when you do that, then you get all those buyers that are looking to get a deal, which is going to give you a lot more lowball offers, making it that much harder to get the best price for your home. So you need to make sure that you're pricing your home very carefully right now at the latest comparable sales. That way you're gonna have the best chance of selling it within the first 2 weeks of being on the market, because that's going to be the best chance you have of getting the best price for your house. So price your home very carefully. Do not get too ambitious right now because buyers understand the interest rates have gone up, demand has gone down. You're no longer seeing 15, 20 offers on most homes. Now you're most likely in the range of, let's say, 3 to 6 offers, which is going to be more typical in today's market. So if you price it over what it's worth, those offers are going to go down even more, and now you might not have any offers to look at, and that really makes it hard for you to negotiate not only the best price but the best terms in the contract. Now let's go ahead and look at my recommendations for buyers. So buyers, I feel for you. I understand that you're probably kicking yourself right now saying, why didn't I buy 3 or 4 months ago when interest rates were much lower? Now I'm able to afford 25% less home. Do I really even want to be in the market right now? The biggest thing for you to remember is that if you're a typical buyer who's looking to purchase a home and live in there long term, which is 5+ years, you really need to be focusing on that monthly payment. Just like when you're trying to buy a car, you're not really focused on how much it costs. You're focusing on what type of monthly payment it's going to be and can you afford it. That's the same philosophy that I recommend for buyers. If you can afford the payments and it's not going to stretch you financially, then now is still a great time to purchase a home. And on top of that, there's a few things that you really need to remember as a buyer. So because supply is still so much lower than demand right now, you're going to have appreciation happen in the market every single month until you get to some type of normal level. And again, that's not going to happen anytime soon. So the longer you wait, the more homes are going to appreciate, and it's going to be even harder for you to purchase a home. Most housing economists are still saying that they expect interest rates to go up, not quite as fast as they have been over the last couple months, but they are still expecting them to rise maybe to the 6% range by the end of the year. So not only are you seeing more appreciation over the next couple months, there's a good chance you'll see interest rates go up as well, which means your affordability is going to get even lower the longer you wait. So you really need to take that into consideration because the laws of supply and demand don't lie. When supply is so much lower than demand, you're going to have home prices get more expensive. Yes, it will start slowing down, so you're not going to see 1 to 2% appreciation every single month like you have been. That's just not going to happen as we get towards the back half of this year. However, you can expect to see 0.5%, maybe even a full percent appreciation over the next couple months as we head through summer. So again, the longer you wait, the less affordable homes are going to be for you. The other thing to remember, again, if you're a typical home buyer who's in there for the long term, is that home values have always gone up over the long term. Because as the saying goes, the best time to buy a house was 10 years ago, the next best time is today. And that definitely holds true in today's market. So if you're in it for the long term, focus on those mortgage payments. So buyers, I do want to leave you with one last thing that's not going to be all doom and gloom for you. So you do have to remember that supply is going up at a much more significant pace than it has been anytime in the last 2 years, and demand is dropping relatively quickly as well. So what this means, especially if you've been in the market for a while, is that when you place an offer on a home, you're not going to be competing with 10, 15, 20 offers anymore. As we get further into summer, you're going to be competing with 3, 4, 5, maybe 6 offers instead, which is going to give you, 1, a much better chance of getting into that home that you want to be in, but 2, you'll be able to make a little bit less aggressive offers that aren't going to take away all of your contingencies and having to pay ridiculous sums above purchase price because it's going to be less competitive. So if you stick it out and you can stay in the market for a few months longer, you'll start to see things ease up, making it easy and more likely for you to get into that home of your dreams. So that's all I have for you today for the May housing market forecast for Orange County. If you found this information valuable, can you please consider hitting that like button below? It just helps the algorithm show this to more people that might be interested in seeing this content. If you're watching this on YouTube, don't forget to hit that subscribe and that bell button below as well. That way you're notified every week when I release a new episode going over different things happening in the market, as well as tips for both buyers and sellers. And if you're listening to this on podcast form, if you can take a minute or two out of your day just to let me know how I'm doing, give me a quick rating, I would really appreciate it. Until next week, stay healthy, stay happy, and I'll see you on the next show. Bye.